Hi guys, welcome to day 5 of trading with Tony. And today we're going to go over intraday chart patterns. So, what have we learned so far? Well, we know that the most important thing for a successful trader is having a profit loss ratio, a positive profit loss ratio, ideally 2 to 1. And a profit loss ratio with a 50% success target, so a good accuracy. What we've also learned is that we need to have the right stocks. We have to find the proper stocks to trade. So we're always looking for stocks with high relative volume. Okay, and in the last lesson we talked a little bit on what a good daily chart looks like. So in this lesson, there's going to be two parts to this section. First, we're going to talk about chart patterns. Then we're going to talk about the actual strategies. So we're going to talk about how we actually trade those chart patterns. So on the one hand, we have very clear chart patterns like bull flags. Bear flags, flat top breakouts, etc. And then we have the strategies for how we trade those patterns. So in this class, we're going to talk just about looking at the patterns themselves, identifying them, and learning the ins and outs of them. This really comes down to how we find entries. And how we learn to take a trade, when we need to take a trade, what are the signals. Every time we take a trade, our whole goal is to have minimal risk. Ideally, we want a good profit potential with that minimal risk. So chart patterns are another way of us minimizing our risk as we trade. We know that the strongest stocks are going to form the best and cleanest patterns. So the patterns that we're looking for, the chart patterns that are my favourite, are the flat top breakouts, the bull flags, the bear flags, and the flat bottom breakdowns. One of our biggest advantages, our competitive edge as day traders, is that we see these patterns unfolding. The hedge funds, the high frequency traders, the algorithmic traders, they're not able to see these patterns very well, right? One of the things we've talked about is how difficult it is to scan for geometric patterns on charts. It's hard for the computer to recognize a pattern taking shape. And of course, depending on how you lay your chart out, or a pattern may look different on my chart than it does on your chart. It can be down to the actual settings or on the layout or how you draw it. So the computer can't compensate for those changes, and as a result, computers are just not very good at identifying patterns unless they're kind of super clear. So our edge as retail day traders is that we're able to identify these very strong patterns that are well respected by all the other thousands and thousands of day traders trading the markets, and we're able to take advantage of that. Now, intraday versus daily charts. So we've talked about how a very strong stock on an intraday level can override a poor daily chart. So even though we're reviewing daily charts, on a regular basis, one of the things that I said previously is that doing homework at the end of the day to find the best daily chart setups is not really something that I spend a lot of time doing. It's not something that I think is particularly important to be a good day trader, because what I've found is that more often than not, a strong stock with a big catalyst can override a weak daily chart. right? And on the flip side, a great daily chart usually can't override a poor intraday chart. You know, a chart on the intraday level that has no volume or has bad spreads and there's no catalyst, even if the daily chart is terrific, there's just not enough people going to be watching these stocks. So our whole approach is following the retail traders and the crowds. We're following the volume around the market. A strong stock with strong volume is going to do things that you know, a swing trader or traders that look at the daily charts are going to think are irrational moves. But we have the volume. And so that's all it takes is big volume. That's why we have to focus on stocks that are in play, right? The stocks that have that high relative volume. Now, with that said, some of the big trades, some of the biggest winning trades that I've made have been trades that have had both the perfect intraday setup and a great daily chart setup as well. So that might be a kind of a perfect storm, a combination, if you will. But I've also had a lot of really great trades that didn't have great daily charts. So I just don't think it's really required for day trading, right? So again, emphasizing that volume makes the pattern. The pattern, so the pattern's forming, and we have that geometric pattern, and that pattern is forming, but without volume. The pattern, it just won't break out. So we're always looking for breakouts. We're not just looking for the patterns themselves. We're not looking just for the patterns to be something we can visualize. We want to see the breakouts. So you always have to ask yourself, does this stock have high relative volume? And is there a spot where I think a lot of volume will actually come in so that a breakout can happen? And when that volume comes in, what is it? It's confirmation. It's confirming that we're right, that pattern that we saw unfolding is being recognized by other traders or where the volume is coming from. So that's really important. When you see a breakout spot, where an area where you think is the apex and no volume comes in, that usually tells you that maybe you're mistaken. You know, seeing that as the apex point, but no one else saw it that way, right? There wasn't the volume, so you didn't get that confirmation. So always look for that confirmation. If you jump in something and you don't see the volume flowing in, it's usually a good idea to get right back out. Just hanging around, waiting for the volume to come in, you're very vulnerable for a quick pullback, because all the traders that got in early, you know, whoever many there might be, eventually they're going to bail out. So if you can get out sooner, your loss will be smaller. Now, for trend continuation setups, the breakouts are best from 9:30 until noon, really, and 9:30 to 11:30 is strong, but 9:30 to 10 is really the strongest time. You get the most volume and volatility. So 9:30 to 10 is really the strongest time of the day. So we look to get into a stock that's already trending. We must look for safe entries, okay, so we can trade the pullbacks and the breakouts, and we want to set a tight stop, because we're really usually buying stocks that are already somewhat extended. So as I said, cleanest breakouts from the open until lunch, and then from lunch on it starts to get slow. And in the afternoons after lunch, afternoons in general are typically slow for pattern-based trading, with the exception of some reversals, and also with the exception of applying some of these patterns to momentum stocks. That's stocks that have intraday news. They have news in the middle of the day. Now, like I said, We want that immediate resolution. So if we think something's going to squeeze at 5:15, when it hits 5:15 and it doesn't squeeze, we've got to get out immediate or bail out. This for me is risk management. It's another risk management technique. So if I see that volume come in and it immediately pops to 525, that's great. I'm in the profit. And if it just hesitates there at 515, 516, that for me by itself, even though the price isn't dropping, the fact that it's not popping is a bearish indicator. So that's why I get out of these very quickly. And then my loss might be a couple of cents. On maybe even just the spread. Okay, but it's not going to be all the way back down to 5, right? Why let it go that far against me? For me, I've found the time that I can be the most aggressive and really take large positions, 5, 10,000 share size positions, is in the first half an hour of the day. Now, the last half an hour of the day can also be strong for end of day runners, so a squeeze into the close, but it's not as common as the gap and go setup. So my squeeze into the close strategy, I'll trade it from time to time, but the gap and go is much more consistent. That's the bread and butter. I always focus on the first 30 minutes. I take what I can from the market, so I take whatever the market's going to give me, and by 10 a.m., whatever that is, if it's $100, if it's $500, if it's a $70 loss or $200, whatever the market's giving me by 10 a.m., take it, and as a beginner, whilst you're learning, as a beginner trader, that's often a good time just to switch off and go back to paper trading. Start trading in a simulator again, and do that for the rest of the day. Get down the mental gym and work on those muscles, if you will. So take the rest of the day repeating the cycle and trying to hone the skill set. So what you do is you take the money you can get by 10 a.m. and then go paper trading the rest of the day. So for these trending stocks, we always want to know that there's a catalyst, right? This means it's a stock in play. So the catalyst, like we've talked about, earnings, press releases, activist investors, if it's a pharmaceutical stock and it's just got FDA approval, some type of news that's really big for that particular stock, or even maybe the sector. Because we can get multiple stocks running in a particular sector, and if it's news that impacts the whole sector, we might get a stock running within that sector. So if we're looking at a sector, that's another thing. It's the news that we're looking for, catalyst that we're looking for, that gives traders a reason to be excited. Okay, so we always want to be trading the stocks that everyone is talking about. There's usually a handful of stocks each day that everyone's talking about, and those are the ones that we're going to be trading. Those are the ones that we're going to be looking for the patterns on. So, the flat top breakout pattern. This pattern is an ascending wedge, okay, and I'll show you a couple of these in just a second, some examples so that you can see these ascending wedges. Ascending wedge is a stock that's recently popped. It's recently made a big candle upwards, and then that creates a flagpole, and then there's sideways consolidation. That sideways consolidation is the flag pattern. So an ascending wedge is a type of flag, and it's consolidating under a flat top. So oftentimes we look for flat tops that are right at a whole dollar, say $50 or $50.50. Those Quarter, half, and whole dollar levels are very psychological levels in trading, and are really good at areas of consolidation, because when we get that pop or over, we're not just getting a flat top breakout, we're also getting a breakout over a key level of resistance, a psychological level of resistance. That's sort of two setups in one. Okay, so the coiling is good. When I say coiling, it's the stock consolidating. It's consolidating under that critical level of resistance. The longer it consolidates there, the more it coils. And it builds up strength for the next move up, like a spring, as it starts to contain energy. So it gains strength for the next move up. Now, we don't want to trade patterns that have a big U shape or double top formation. So a stock that pops up to $50 and pulls back to $49.50, then comes all the way back up and creates a big U shape, that's got to be more of a double top. And double tops are a little bit riskier. What I prefer to see are stocks that come up, tap that resistance level, that half dollar or whole dollar level, and then consolidate sideways. You consolidate right underneath it. Okay. So, where do we get in? What are the entry indicators? What I'm always looking at is the breakout over that critical level of resistance. Okay, so the resistance level, if it's $50, I'm going to want to buy right over 50, and I'm going to set my stop at the low of the last 5-minute candle. So when I'm setting these stops, I always look at the low of the last 5-minute candle, because if we're making new highs and we're not making new lows, that tells me the pattern the trend is intact. If we have a candle that starts to make a new low, that tells me the trend is starting to change. So as long as we're still making new highs on the 5-minute, or at least not making new lows, I'm willing to hold my position. Now, there are times where the low of the last 5-minute candle is too far away, and in that instance, I may use an arbitrary stop, like a 20-cent stop. So, if we don't get that immediate breakout, and I'm say buying at $50, we don't get that immediate breakout, what I will often do is just go ahead and sell half, and then wait for a moment, see if we get the volume. But because I've sold half, I've reduced my exposure. It's only a little bit, but if it does pull back, which is my expectation. If something is not popping and it does pull back, at least I'm reducing my exposure. So the loss won't be as bad because I've scaled out. Then if it does go, then okay, that's great, it goes, and I've still got half size. I'll do that on patterns that are strong. The stock is strong, but we don't get that immediate pop. So, I may not want to sell my full position because I still like the look of it. So instead, I'll just sell half, and I'll just have my hand on the trigger ready to bail out. So again, the longer the coiling period, the better, right? When we have this long period of consolidation, we expect the breakout is going to be very powerful. So if we don't have that, we don't have that big spike in volume, that's really a problem. That tells us that people aren't watching this stock for a breakout. So flat top breakouts are these consolidation patterns that we look at. And we look at these up until noon. I would say is a good time to keep considering them. So when I say noon, I'm talking about market time, so East Coast time. So we look at these up until about noon time in the afternoon. A lot of times this pattern, the flat top breakout, it just doesn't have the strength unless it's a stock that has breaking news in the middle of the afternoon. So We'll talk about different strategies where we would use this pattern. So this pattern right here, it can be a sub strategy of the momentum trading strategy, possibly the reversal strategy, depending on how you use it, and definitely the gap and go strategy. So I'll use this pattern. I'll look for a flat top breakout on a gap and go strategy trade. I'll look for a flat top breakout on a momentum strategy trade, and we understand the pattern and how we trade the pattern. But it's going to change a little bit depending on which strategy we're trading it with. Okay? Your exit indicators for flat tops are now, so like I said, your stop or your exit indicators or stop is at the low of the last 5 minute candle. So if I'm risking 10 cents, my goal is that I'm going to be making 20 cents. And I've got to use that 2-to-1 profit loss that we discussed in the lesson 2. Okay. Once I can sell half at 20 cents, I'll adjust my stop to break even. And that protects my profits on the trade. Now, oftentimes, even if I had a 20 cent stop, once I'm up 20 cents, 25 cents, I'm going to start scaling out a little bit, taking some profits. Because, you know, being up 5 or 10 cents, that much, it isn't much, but being up 20, 30 cents, that's more significant move. And that tells me that I did time my entry properly. So I do want to start paying myself when I'm up kind of 20 cents on or 30 cents on a move. And then we'll use maybe a trailing stop. You can either do this in your system, or you can do it mentally. You use a trailing stop, and that keeps ourselves in the driver's seat. And try to hold the stock as long as possible. So get as much of the move as we possibly can. I'll go over the different trailing stops that I use a little bit more in the trade management section, which is another lesson coming down the line. But for now, I just know that if I'm up, I like to lock in a little bit of profit and then adjust my stop to break even. And if it keeps moving up, I'll keep adjusting that stop to more profit. And that's a way of managing risk. I'm keeping myself in the routine of having lots of small winners, you know, some small losers, but not having those big blowouts. I hate going from 20 or 30 cents, going from 20, 30 cents up, not only back to zero, but actually a loss and losing money. That can be incredibly frustrating, incredibly. So this right here is an example of a flat top breakout. So this is a stock that popped up. You can see the yellow line that's been drawn there, which is the resistance line at 470. We had consolidation, so we popped up, we pulled back, and we come up and tap it a second time. Okay, so where's my cursor? Here we go. So we pop up, we pull back, we tap it a second time, and that right there, that's a double tap. So that's a double top. Okay, so we tap once, we come up second time. You can see how we have a bit of a U shape here. So this pulled back a little bit. So buying on this double, that's a little bit risky. What happens? That double pulls it. It doesn't break out. It pulls it in. So if I bought there, I would have got stopped. I would have got stopped out and then it comes up for a third time. It pulls back just slightly, and then it goes for a fourth time. And the fourth is the breakout. So first time Second time, it pulls back. If we'd gone for the double top here, double top breakout here, it would have faked us out and pulled back, would have got stopped out. And third time, pulls back a little bit. Now on the fourth time, and we can see down here the volume comes in, but this is the actual breakout. So I always wait for 40, 70 to print. I wait for it to actually break this resistance. Okay, and then I buy. So that way I'm buying right here. I wouldn't have. I'm buying right here. I wouldn't have bought here because I didn't have the break. So I'm buying as it breaks up on this one. Okay. Now that second tap didn't have the break, and the third tap didn't have the break. So sometimes, you know what, sometimes what happens is we get a little wick like we do here. We get a candle wick and it comes back in. And, you know, sometimes I'll bail out there. If I'm feeling like it's faked me out, I might bail out. But other times, we get this nice move up hit. So here we move up to 5. 5 looks like 505, 510. So this is a very nice clean move up, and this one here all the way up, we get the move up. So using the 5-minute chart, this is a flat top breakout. This flat top breakout, and it's happened. It just happened to have a good trigger on the daily chart, but notice what time of day it was. Okay, a big spike came up in the morning, so this would be a gap and go strategy. We probably would have traded this for a gap and go, and then it says stays in stock, and this stock stays in play as a momentum stock. So when we get that sideways consolidation, and then the pop up around 15, 11, 11:15, 11:30. So here, 11:15, 11:30 on the time thing. So when we get that pop up there, we peak up at 12 noon, and then sort of sideways during the lunch hour, and you know, I actually don't know where it went from there. But that's a really nice flat top breakout. That's a pattern that we're looking for, that ascending wedge. So the bottom of the wedge is the support. That's the support line coming up. It's an ascending support line, and that forms and this flat top. So we've got the bottom of the wedge here. So take a line from up there. It's a trend line. That's your bottom of the wedge, ascending the bottom. That's your support line, and the resistance point is this point. This resistance point is the top of the wedge. So we've got the side of the flagpole, if you will, here. Then we've got this ascending line, ascending trend line, and then so we've got an ascending wedge with a flat top, and that flat top forms the wedge. Okay. Now, here's a flat top breakout. This is a symmetrical wedge. Okay, so instead of being a flat top here, we don't have any flat top. It's actually descending. Okay, so we're looking at descending. So we don't actually have a flat top. It's just descending resistance and ascending support. And the apex point is right here where the two lines cross. So we've got this up here, coming down, that's coming up. So two trend lines, and the apex point is here where it crosses. Okay. Now in this case, the stock started breaking to the upside just before that apex point, and you could buy it down here. But do you see the volume coming in there? Okay, volume starts to come in, and we see on the big candle there where the volume comes in. So the volume is incredibly important. So there's a little bit of buying volume just before the apex point. Some of the smart traders are coming in early, but the majority of the volume comes in right at the high of day spike. So that's this one. So we've got this high of day resistance level, and that's where the volume comes in. So we've got this apex you could buy in here, and we see a little bit of volume coming in at the apex, but then we've got this huge volume candle at this break of the high of day. So we break up on volume. That's a big volume, and it comes in right there as we spike to new highs. The problem is that we have a bit of a U shape from where it popped up to where it actually breaks the high. It actually pulled, it popped up to 37.70, and then pulled back. It pulled way back down to 36, and then it came back up here. So there's a lot of negative space in between, and that means there's more risk. That means our stop is further away, and in this case we broke 37.70, we popped up, we squeezed up, it looks like $39, almost $40, which is a big squeeze, but we weren't able to hold, and we pulled back. So this is a good example of why it's good to take profits into these squeezes, so you don't let this winner turn into a loser because you sold down here on the bottom. It pops up and then it pulls back, so you don't want to be selling here for a loss. You want to be getting in as we break the high of day here. Take profits on the way up. You do not want to be, even though it bounces here and goes right up, it's risky and we're going to get stopped out here. So we don't want to be making a loss on a pop like this and selling down at the bottom. So whenever we get into a trade that spikes up like this and then sells off, I take the profit, adjust my stop to break even, and then in this case I would have gotten stopped out. I would have got stopped out at the previous high of day. Now, as I say, it did continue up and made another move, but we could have got back in for the retest. Got a second trade on the retest when it broke that. When it broke that high of day, that previous high of day for a second time. So this particular case, the second trade would probably been the break to new highs. So this is the previous high that pulls back. So we may get in here for the break, and then there's pull or the pullback here. So we're getting in here for the break to new highs. Okay. So maybe with a small winner or small loss, depending on where you stopped at. And then when it broke the high of that candle, that's when it really took off. So you can see when you have a tight consolidation along the highs, your breakouts are stronger. When you have a looser consolidation, like here, your breakouts are going to be weaker and choppier because you have people that bought down at the lows, and they're going to sell into this move, and you have short sellers that are going to come in and short, you know, the spikes here around this apex area, because it's overextended. Right, okay. This is a symmetrical wedge, and then it forms a little bit of a double top, and then it consolidates and then makes another bit of a breakout from there. Okay, on this one, on this stock, consolidation on this one, 776. Oh, 796. Sorry. Um, this is nice. This is a nice one. We get that nice quick gap and go, right? We pull back and then we surge up. Really nice move. A little bit of consolidation here, and so a little bit of consolidation, a little bit of consolidation, and then we get a breakout and then more consolidation. So a little bit of pullback and then we come back and back up, and then when we break that level again we pop. And if you look at when we actually break that level, look at the volume. Look at the volume here. When we break that level, we actually break that high, the previous high. Look at the volume come in. We have that big volume bar right at the same spot as the breakout. So that's the confirmation that other people are watching these levels. This stock also happened to have a very strong daily chart. There was no resistance nearby, but this wasn't going because it had a strong daily chart. It was going because it had a news catalyst. Now, here's another example. Stock pops up right at the beginning of the day. Pops up here. Oh no, this is midday. Stock's up. It pops up, and you can see, where are we? Midday. So this stock pops up here midday. Consolidation. This is a little bit of an unusual time of day to have this type of consolidation, but we consolidate right under 12. 1197 was the high, and we tap it and we pull back a little bit, and then we come back up and we break it, and the volume comes in, and it comes in at the break of 12 and go from $12, big spike up, and now traders that miss that move see this consolidation. They buy the pullback, and look at the big volume. Look at the big volume. That comes in as we break now, and in this case again we've got a little bit of a U shape here, so we could choose to either buy the high, which is 1412, or we take a start on the pullback with a stop at the lows. So we could have a stop at the low of the pullback here, just over kind of 13 ish. Could I stop at the low of the pullback and start taking a position there? If it's a strong stock that was a strong stock with news out, you can see this type of day it had from $8 all the way up to 18. So it had a really big move for this stock. So when we see consolidation on a very strong stock, it's safer to think that this could be this could be bought. This pullback could be bought up. Okay, so in this case, it's okay to sometimes take a little bit of a position here, and get in early. And early means you don't have confirmation, but if you can get a tight stop, then your risk reward ratio is going to be really good. So that's why I'd consider it and see it spike up to 1412, through 1412, a little bit of pullback, and then it goes again up to 1672. Okay, so that was a really nice one. Now, here's another flat top breakout. It's 339 is the high. We pop up, and we pop up initially, then we pull back, we pop back up, consolidate over 340, that was a spot, and then it spiked up to, I believe, 375. But you can see that this is very clean. It's a clean pattern, and a big spike up, sideways consolidation, and the easy spot to buy will be down here at the bottom. And which is why buying here at 339 is buying the double top. Buying the double top is risky. Wait for it to pull back. Now it's a triple top, so we've got a flat top forming, a very clear line in the sand. Anything over 339, that's a spot where a lot of people buying volume is going to come in. That's a spot that when it breaks, that's when everybody else is watching. Then it's off to the races. Okay. Here's a flat top breakout on another stock. We've got our consolidation here, right under $30, and we can see that this is a stock that had made a nice move. Consolidation right under 30. It's got up to here, and then it's consolidating. We can see it tapping the $30 on a number of occasions. It's made a nice move. It's made a nice move up, had a nice daily chart. For a clean daily chart, when we get that consolidation right under $30, so we have two setups. We have a consolidation under a critical level, which is the whole dollar, and it's not just a whole dollar, it's a $10 level, which makes it even more poignant. It's the resistance, the double zero, right? $30, so the whole dollar, and then we have a flat top ascending wedge. When we get the breakout, we have two things happening. That's sort of the logical place to put stops is right around the whole dollar, because that's an area of resistance. Once we break over that, you know, a lot of times it's just going to, it's just good to bail out, cover your short position, so you have shorts that are going to cover. Okay? That helps us, and you're going to have others that are going to jump in. They're going to jump in right here. Okay, other traders that are going to jump in right there, and they're going to jump in for the breakout as we are. Now look at this breakout from $30, and it went right up to 32.66, 65. Look at that mean. Look at that move. I mean, it's huge. Over $2.50. That's a beautiful flat top breakout. And here we had a really nice consolidation before it in grey. It's highlighted in grey. So the nice consolidation there. In this case, there really wasn't a good opportunity to buy on a pullback. You had a teensy-weensy U-shape right here. Between the green candle, the orange candle, and the high of the greys, when it tapped up went and retested the $30 level. You got that little U shape, and these are also called cups. So you had a little teeny cup formation here, but not very much of one. So it's not like anyone that bought at that stage. You're not going to have to worry about people selling into you, because this was the clear spot. This here is the clear spot to buy. Now this is an example of what I was talking about earlier around coiling. This is an example of a very tight coiling pattern. So the tighter the consolidation, the better. the stronger the breakout. When they go, they go. Okay. The inverse of that we want to be looking at are flat bottom breakdowns. Same thing, the just in reverse though. Okay, so it's the exact same setup, it's just in reverse. Now I'm more biased to the long side. I tend to trade more on the long side. So I find the flat top breakout to be much more successful. It's much more suited to my style of trading. So it's a much more successful pattern for me than the flat bottom breakdown. So I'm not going to spend a lot of time focusing on the flat bottom breakdown, other than to show you this one example here. And we can see how it consolidates, it touches the lows here at 50.75. It sells off, touches the lows, pulls back, comes back for a retest, another retest, and then it taps it again before it actually breaks it actually breaks with a bit of momentum. So the consolidation of the lows and then the sell-off, it's just the reverse of the flat top breakout. But if you like to short stocks, this is what you should be looking for. So take the last few minutes we're talking about flat tops, turn it upside down, and that applies to if you're taking a short position. So I'm not averse looking at that. If you want to look at some more, just email me, and I can send you some more examples of flat bottom breakdowns, and that's not a problem. But as I say, I'm more long biased, so the principles apply exactly the same, but just in reverse. Now, another pattern that I really like is the bull flag pattern. So this is the second pattern that we're going to talk about in depth. Bull flags. Now, I saw a bull flag on one last week on the live, and I highlighted it and showed it to the live stream. They're a little bit riskier to trade than flat tops, but a lot of the times they work really, really well, especially on high volume stocks, and especially in the morning, or if we get breaking news in the middle of the day, when we have news. So we'll look at a picture of a bull flag in a minute, but the bull flag, essentially, it's a stock that moves quickly up to form the flagpole. And we talked about the forming of the flagpole and the ascending wedge just a few minutes ago. It moves quickly up and then pulls back for usually 2 or 3 candles before making another big move up. Okay, so whenever we see that pattern, we know we're looking at a bull flag. So a bull flag is essentially we're considering buying what you might look at as a double top. But we hope that the pullback isn't so much that there's a big cup or U-shape formed. Okay, so with a bull flag, we really just want to see a spike up, and then a few candles that are almost just sideways rather than really pulling way back. And then as soon as we get that volume coming back in, a quick ramp up, small pullback, and then a go. It's one of the ways I find the stocks that are forming bull flags is just by watching my the surging stocks scanners. So I'll talk about where I'm seeing surging stocks in kind of over a 5 minute period. See the momentum strategy when we're looking at momentum scanners. So when we're looking at on the scanners, and we see that the stocks that are starting to surge up on the scanner window, that's what we're looking for, because that tells me where there's the most volume in the market at any given time in the day. So any stock that's experienced a ton of volume it's going to be potentially on one of those scanners if it's at any point during the day, and I can look for bull flags forming on those stocks. Now, where do we get in? Well, both flag patterns, when we're looking for entry, we want to see that sharp ramp up and then a small pullback. So the pullback, generally I don't want to see more than 30% of the move up, so a third of the move up, and it has to hold half the 50% retracement line. So if something spikes up a dollar and pulls back to 70 cents, that's fine. That's good. If it pulls back to 50 cents, well, I don't really like that. So I'm not as big a fan of that. So if it breaks the 50 cents, it's no good. It's broken. It's broken that pattern. Right. So depending on the strength of the volume and the time of the day, you can apply bull flags to either 1 minute or 5 minute charts. So on a 1 minute chart, if you have 3 or 4 candles that spiked up because we have breaking news, for example, in the middle of the day, we look for the pullback, and then the first 1 minute candle to make a new high, we can jump into that and buy it at that new high, and we look for that breakout. Okay. So if there's not enough volume on that 1 minute, then we might look for both flags on the 5 minute, and that works too. Okay, it just depends how much volume there is, and how strong the catalyst is. Now, your stop on a bull flag is always going to be at the low of the pullback. So in the example, we have something that spikes up a dollar and pulls back 50 cents and then starts moving back up. Your stop's going to be at 49 cents, 50 cents. You can have a very tight stop. You can get in there, but it's a very tight stop. Okay, the very low of the pullback. Right. Now, when do we get out? It's a good question. What's your exit indicator on a bull flag? Well, like the flat top, exit indicators, I set my stop at the low of the last 5 minute candle. If I'm using a 5 minute chart, or the 1 minute candle if I'm using a 1 minute chart. So once I've started to hit my profit loss ratio 2 to 1, even if I just have a 1 to 1, but I'm up 30 cents, I'll start locking in a little bit of profit, and I'll adjust my stop to break even. So the time to get out of a bull flag is the first candle to make a new low, either in the profit zone, or if it's at a loss, you're at a loss. Either way, as soon as you have a candle making a new low, time to get out. Let's have a look. Okay. This is a bull flag. So here, we get the stock. We buy the first pullback on the gap of momentum stock. A big spike here to see the big spike to 37.50, and then a little bit of a pullback. We didn't pull back as far as $37, so which would be the kind of low of this point. So if we're taking this as the start of 36.50 as the start of the move up, and then we get up to 37.50. So we don't get a 50 cent pullback, It's a nice. It doesn't go back as far as $37. So it's a nice move up, a slight retracement, and then we go again. So buying right here on this green candle, right as it makes a new high above this previous red candle. That's the break of the bull flag, and you can see that as we do that, there's a spike in volume because people are seeing this bull flag here forming. So they're looking at the next green candle to make a new high, which is here, and we see this volume candle here. So we're seeing a surge of volume, and that comes in as it breaks the previous high of day. Okay. But in the bull flag, we're in a little bit earlier, which is why bull flags are a little bit riskier than flat top breakouts. But you know, with that risk comes a bit more reward. So we're in this a little bit earlier, and we're going to have a little bit more of that move. We're going to have a better average. Okay, so over 37.50, it pops up to 38. Sideways, we sell the first 1 minute candle on the 1 minute to make a new low. It's this red candle here, so we're selling here, and we bail out right there. You don't have to wait for it to hit. You know the low of that candle period. As soon as it makes a new low, you can get out. Now, let's have a look at this one. Now, in this stock, it's a very nice flag pattern. Again, we have surging up momentum stock. So this was on our scanners. The stock surge is up a little bit sideways. Sideways consolidation, and now, like I said, I usually like to see 3 or 4 candles of pullback, and then I go. This had what is it? 1, 2, 3, 4. So 1, 2, 3, 4. Yeah. So this had 5, and that's a little more than we typically like. But we're still going to look for the first candle to make a new high, and that green candle made a new high. It pulled in, it didn't make a new low, and then it goes. Right, this would have been a little bit of a kind of a nerve-wracking moment right here, as it pulls back, but then it goes, because you get in, and you're not quite sure you made a new high, and then it pulled right back. And has it faked you out? But then it goes on to the next candle, and okay, now we see the volume on the bull flag, volume pattern on the bull flag, and it's important. You're going to have strong volume. You want heavy volume on the ramp up. So you see the super heavy volume, and then you want light volume during the pullback. So this tells you that rather than shorts coming in and just slamming this thing, it's really just a few people that are taking profits, that are selling the shares, they're getting out, whatever, but it's more just digesting or consolidating rather than experiencing a huge sell-off. Now, when we're looking at stocks to reverse, when we're looking at the bottom bounces, we look for stocks. When we look for stocks to reverse, when we're looking at these bottom bounces, we look for a stock, or in this case, we say we want to short this. We want to see a stock that has tons of volume on the ramp up and peaks out at the top, and then there's volume. So if we're looking at here, it's volume selling off. Okay, so we're looking at volume selling off too. Okay, so high volume on the ramp up, but then no volume on the sell-off. That tells you that it's probably going to make another move up. In this case, I had to pull back a little bit before it was ready, but it did end up making a nice move back up. So this is a bull flag. A little bit more here. This is also a bull flag pattern. As we may go, just want to go over this here again here. So we're getting volume spikes here as it moves up. We get large volume on the move up, then a little bit of a pullback, a bit of consolidation before a bigger pullback. So this is still a bull flag, but what we're actually seeing here is this is your actual high. Okay, so a little bit of consolidation before a move up to the previous highs. So then we're actually getting the pullback when we're getting sideways move, but it's not. No candles are actually making new highs. There's no entry position. So we're getting new lows, which tells us that none of these candles are the break of this bull flag. Now we're getting a number of candles. I only like to take 3 or 4 typically, but you can see the same thing applies regardless. So when we actually start to see this consolidation here, we're getting a new high here. We can actually draw this line. And if it then gets a low, we start to see volume come in for a break of this flag. And an entry position here above that trend line. So it's a different way of looking and drawing a bull flag. We've got effectively a flat bottom here. And that's the low of the consolidation. That's the pullback low. So if it goes below that point, it's a breakdown. But we're not getting any further lows. So what we then get is this surge in volume down here, surge in volume, and with that comes the breakout of this trend line, the top of the flag, and we move all the way up towards 83.50, 83.70. Okay, and again, here's another flag. In this one, we've got a good daily chart. This is just a little bit of consolidation here right under 17. So we see a little bit of consolidation and we make a move up, a little bit of consolidation in this case. Consolidation is basically just sideways. We don't even really pull back, and then we break over that whole dollar level. Remember what I keep saying about quarter, half and whole dollar levels being psychological resistance and psychological support. Now, if you look at that pop there at 1696 all the way up to 1754, a little higher it looks like. So a nice 50-cent move right off that little flag. So flags are going to come in different shapes and forms. Now this one happens to be very tight and almost no pullback, very little consolidation. So it's almost a flat top, but you know it hasn't tapped enough times to be considered a flat top. Okay. Here's another bull flag here. A little pop up, a couple of candles of pullback, and then it goes a couple candles, we'll pull back, and then it goes. All right. So in these on these pullbacks, pull back to the 990. 9 moving average. So if you're looking at the moving averages here, it's pull back to the 9 moving average, and then it bounces and respects that and then goes. If you're using moving averages and you're using as part of your strategy, the pullbacks to a moving average you can use the moving average as your stop. So if it breaks it, then you've actually got your stop level there, and it's a fluid stop level, almost like a trailing stop level as well. So if you're using moving averages as part of your strategy, you can actually utilize that as a safety zone. Okay. Now, let's look at the this chart here. Okay. This is one a quick pop up, a couple of candles of consolidation, and then a little bit of pullback, then another move back up. Okay. So this is the pattern that I'm using almost every single day. These are the patterns that I'm looking at when I'm trading, in particular when I'm trading the gap and go strategy. So like any trading strategy, the strategy includes specifically what type of stocks I'm going to trade, what time of day I'm going to be trading, what my average profit loss is, what my percentage of success is. The strategy has a lot more information than just the patterns. But in that strategy I trade, this is one of the patterns that I'll trade. I'll trade the bull flag. Now, here's another bull flag. Where's my button? Here's another bull flag pattern, and we see it actually pop. And we pop up, a little bit of a pullback, and then another pop up. And this one ended up being fairly small move here, but it pops up to kind of 71, and then it pops up, and then it can't hold that level, and that's why it's good to take a little bit of profit into the move, because when you hold these and they start turning sour, they can make a really quick pullback, and that's not something you want to be holding through. Now this one's actually pretty frustrating because you can see it popped up, it pulled back, and then it rips. So you know why some stocks do this. You know, it looks like this particular one, news came out around 11:15. There was breaking news, so this stock was of no interest. Then all of a sudden, news comes out, and when news comes out, these stocks can be pretty volatile. Right? You can have these quick spikes up, and then spike down, and so a lot of choppiness, and then they start to choose a direction. No, that's bull flags. The reverse of bull flags are bear flags, like the flat bottom breakdowns were the reverse of the flat top breakouts. Bear flags are the reverse of bull flags. Now, it's not a strategy that I trade very much, but in general, it can be good if you are short bias. It's a quick drop down, a couple of candles bouncing, and then more sell off. And any pause in the selling is considered bearish. Okay, so weakness in these trades a lot of times can just result in sort of day-long grind to the downside. So if you like trading to the short side, here's as we go. If you like trading to the short side and you're good at recognizing these patterns, you can apply the bear flag. If you can apply them to weak stocks that are selling off or that are at lows. In most cases, anything that I'm looking at for bull flag is going to be at high of day. Anything that I'm looking at for bear flag is going to be low of day. Same thing with flat tops. Flat tops are consolidating at high of day. Flat bottoms are consolidating at low of day. let's talk about the actual catalysts. News and IPOs. This is an important area to discuss because these stocks can be extremely volatile and very risky. Even when we have bull flags and flat top breakouts forming, these can still be very choppy. And what we think is going to be a very clean breakout a lot of the times is just not. So just remember that news is risky. You can easily be down several points on trading news. If we had a stock that it bounced and it dropped 15 points and then bounced back up, so from 95 $195, it dropped down to 180, and then it made its way back up to 195. So that kind of volatility from news, imagine if you've shorted it at 180, $180, and that bounce is 10 points against you. So it can be huge. That can blow up your account right there. So while we look for volatility in the markets, and we want volatility, we want to trade volatility in a way that's relatively predictable. We're trying to manage our risk as best we can. So if we're trading news and we don't understand the news, it can be very risky. And the thing is, even if you think you understand the news, you may have a good understanding of or if you know that business or the sector, but the reality is, news that you expect to be interpreted one way could end up being interpreted a completely different way, and that's one of the most frustrating things with trading fundamentals. Is something that you think is, a fundamental sign of weakness, the market's going to react strongly in a bearish way, but the stock runs. It doesn't make sense, but that's what sometimes happens. So with news, you just have to be very careful. I do trade news from time to time. I do trade IPOs from time to time, but they're risky. And you just have to take it easy. The big thing that I look for when I'm trading news is lots of volume. So I want to see the volume coming in and sustaining. All right. So the first candle, 200,000 shares. Second candle, 200,000 shares. That's not. Oh, sorry. Second candle, 20,000 shares. That's not good. All right. We want to see sustained heavy volume, and that's really important. So, an example. If a stock has news, and we trade this, and this stock, there was some Carl Icahn activist, investor. Speculation is what it was. Okay. We can see where this, I'm not sure what the date was, but this pops from 62.50 up to 65. That's a big move. Okay. Now we're familiar. We should be familiar with Carl Icahn. We may be familiar with some of the other activist investors. We know that when they get in stocks, lots of people are watching. For Carl Icahn, see Cathy Wood, see Warren Buffett, see Elon Musk. So we know when they get into something, a lot of people are watching them. There are certain types of news that we just know that's a big deal, and this is one of them. In this particular case, you can see this. This is 1 minute. This is the 1 minute chart. The 1 minute chart. It didn't even pull back. It just started ripping. So when I hear activist investors are in something, a lot of the times I'll just take a stab at it. But I'm not going to go in with my full size position, because I know when you go in full size, you need 100% confidence that you're putting, if you're putting your full size position into a stock, as soon as you get in, you've got to have total confidence it's going to go your way. So with a news trade, it's hard to have total confidence, even if the news sounds amazing. It's still hard to have total confidence. So with these, you just have to go in a little lighter, because sometimes you're going to take a news trade and you're going to get destroyed. Especially if you take size that you know could take, you could take 200 shares and lose a point, and you're just like, wow, that was so fast, and I'm glad I only took 200 shares. However, if you take 2,000 shares and you lose a point, you've lost 2,000 shares, because that's how quickly they can go against you. Here's another one. Here's another example. Okay. This is an example of a news trade. It was Gilheed. This is a good example of a news trade, also having a tradable pattern, but this is where we can get into developing. This is where we can get into developing a strategy of actually trading news, where the strategy might be, well, we trade, pharmaceutical stocks, pharmaceutical stocks that have breaking news midday, FDA approval, stuff like that. What patterns do is we trade in this news-based strategy. We buy the first pullback. So if you buy the first pullback, or say I buy the first 1 minute candle to make a new high, like you would with a bull flag. In this case, you're a buyer at 96.80. 96.80, and it spikes up to 98.70. A little choppy along the way, but a fairly clean move. So we got in this, sold a little bit up at kind of 98, 98.50, and it pulled back. I can't remember much about this particular one, but you can see the 1 minute candle. The next 1 minute candle to make a new high was a small tight flag. Okay, so get in there. The next one. So it pops up a couple of candles of consolidation, and then we make another move up. Now, this one is an IPO example. And this was an IPO that was halted. I guess a couple of times it was halted. If we look right here, it was halted, because you can see that where this candle starts is not the same as where this candle finishes, and here. There's a halt. This goes into a halt up and resumes here, so it's a halt, and then it resumes here, pulls it back a little bit, and then carries on moving up. Same thing here. It's there, halted, and then pulls back. So we've got a couple of halts on the on in the way as well, but. So when it's surging up, and it's halted, and then it reopens, and it's surged up, and it's halted once again. So in this case, it's like 3 times, and then it's dropped down. It was halted a 4th time as it dropped down, and then it was sideways for a little while. Where's your entry point? If you're looking at that, think about it. Is that something you want to trade? Because this is an IPO example, and this is how risky they can be. You can see that if you get in there, there's a potential big profit to be made. You can if you got in and before this on the pullback, so it halted up here, and you got in for a pullback here. You had a tight stop at the low 2170, 2150. You had a stop at the low there because it's halted up. So you watch that candle form. It's moved up again. It's come here. So as it pulls back, you might want to wait for the next green candle to make a new high. As it pulls back, you've got a tight stop there at 2150. But it doesn't. It moves up. So you're in this. You take some profit along the way. You get caught in a halt. When you're caught in a halt, you then gaps up. You're in profits. You might want to moving your stop loss. You might say, okay, well, my new stop loss is the high of this previous candle, not even the low, but the high of this previous candle. It pulls all the way back. You don't get stopped out. It pulls back to the VWAP here, and then it moves up again. It's halted again, and it gaps up again, and this time it pulls back. So it's very, very risky, but these can be from, in this case, $18 all the way up to $30. It's a huge move in a matter of about 20 minutes. So IPOs and IPO news can be very risky. We can get home runs, absolutely. If we go back to when I traded my biggest trade, the live on stream there, that was a recent IPO, and it behaved very much like this. And I was, buying a pullback for a move up, and I got caught in the halt. So they can be very, very profitable. And we can get those home run hits with these, but they're extremely risky. We can really, are we going to go in with the amount that we don't go in full size, is what I'm saying. We want to manage our risk. I keep saying throughout these lessons that the fundamental principles of being a good trader is risk management. So we go in and we're looking to manage our risk. Okay, so we don't go in with the amount of size that we would need to really get a home run winner. We can scale up, and in this case, that's exactly what we would do. So we would maybe get in here for the break of the we get the news, we get the break of the new candle, the new high. So that's where we get in. We take a little bit of profit there. And we're moving our stop levels up. So as we're getting in, we're taking profit. We're stepping up. We're adding to the position. We're taking profit. We'll move the stop levels up. Our break even on the trade is getting, because constantly taking profit. So we're actually stop stepping our position until a point where, hang on a minute, we have this big red candle that halts. Ideally, we've already got out, but it's a difficult one to trade in terms of if you jump in terms of 5, 6, 7,000 shares, but you can make quite a bit of profit if you using the step stairs in there. You can make $5,000-6,000 profit with reasonable size. On a move that is $12, but it is high risk, and if they go against you, they can blow up your account. So you do want to have risk management and manage your risk accordingly. Okay. Okay. So when we're looking at an intraday chart pattern, we're focused on chart patterns that as another measure to reduce our risk in the market. So all the steps we've taken at this point, from learning risk management principles, from the 2-to-1 profit loss ratio, the percentage of success that we need, our accuracy, trade accuracy, that we need to survive in the market, right? So choosing the right stocks is part of it, and which types of stocks does the strategy work on, which stocks does it not work on, okay? So then we look at the daily chart setups and now to intraday chart patterns. All of these steps are steps to managing risk, and it's what we do every single day. What we do is we sit here and manage risk. That's what makes us successful traders. That is ultimately what will make you a successful trader, is if you're able to manage risk properly. Like I've said before, choosing the right stocks is important, but it's not as important as learning to manage your risk on every single trade. So, by only taking strong chart patterns, you're again reducing your risk as a trader. We know that these chart patterns have a certain percentage of success. If we're taking patterns that are anything less than perfect, anything less than a perfect pattern, our odds of success are going to decrease exponentially. So as the pattern gets weaker and weaker, our odds of success are going to drop quickly. So we only want to be taking the strongest setups. So when you sit down in the morning, you have to say to yourself, I'm only going to take strong setups, and if there aren't any strong setups today, I'm not going to trade, right? This might be a day where I don't get in any trades. You have to remember, every single day you're in the market, you're learning. Once you develop one strategy that you can trade, you're going to be able to survive in the market, and you're going to be able to tread water, right? Treading water is better than drowning. So even if you're not an Olympic swimmer, this kind of comparison, as long as you're treading water, you're doing well, you're surviving. You have the opportunity to continue to learn as a trader. So honestly, trading, learn how to survive trading until you learn. I've heard so many traders say that the longer you're in the market, the more you learn. I still learn every single day that I'm trading. This is a job. I know someone that's been in the markets now that was a little bit of a mentor for me when I was losing, and they've been in the markets now for about 9 years, and they still come to me with new ideas. So that even they're still learning, and the markets change. And the behaviour of the markets change, so you need to continue to learn. So I learn every single day that I'm trading. This is a job where you'll never get to the point where you've maxed out on your learning possibilities. That's just not going to happen. There's always going to be room to improve. There's always going to be room to continue learning. So, you know, the trader that you'll be in 6 months is going to know more about the market than you do now. The trader that you're going to be in 6 months is going to be able to make better decisions than you do now. The trader you're going to be in 6 months' time is just going to be much better at managing profit and loss and managing risk versus reward. So if you're thinking about taking 5,000-10,000 share monster position sizes, hold off on those until you've got a little bit more experience and you're a little bit more confident, right? Let's see you in 6-9 months handle those big position sizes, and rather than trying to do it now, because doing it right now might be too soon, especially if you're a new trader or a beginner trader still developing consistency. So, anyone that's got any questions, that's what we've finished this lesson. Anyone that's got any questions, ping them on an email to me. Drop them on my live chats, my live sessions as well. If you've got any questions, feel free to email me. I'll get back to you just as soon as I can. Tony@hustlewithtony.com is the email address. And thanks for joining us. The next lesson is going to be on strategy. So intraday trading strategy. We've learned about intraday trading patterns. now we're going to be talking about intraday trading strategies. So remember to join me for that lesson. By all means, go back over the previous lessons, rewatch them, make notes, start applying those principles to your learning and simulator practice. And I'll see you in the next lesson to learn about intraday strategies. Thank you very much.